Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. Hello, I am your host Pushpendra Mehta, Executive Writer at CTMfile. Joining me today are Bob Stark, Global Head of Market Strategy at Kyriba, and Jack Large, Editor of CTMfile. It's time to get some deeper insights from you on our themes for today, namely the failure of Silicon Valley Bank and Signature Bank, ChatGPT and corporate treasury, treasury work model, payments fraud, and ESG financing. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Let's get started with our first story for today, which is about the collapse of Silicon Valley Bank and Signature Bank. The US government has stepped in to stop a widespread banking crisis after the historic failures of Silicon Valley Bank and Signature Bank over the weekend, which are considered the second and the third largest bank failures in US history. President Joe Biden has reassured bank customers that they are protected and they have access to their money as of yesterday, Monday, March 13th. What worries you most about these failures, and how will the turmoil in the banking industry impact corporate treasury in terms of being able to effectively manage liquidity?
There's a lot of different questions we could decompose out of that. I'll start at the very top of it. What's the knock-on effect of this? The knock-on effect is that if it's just a US problem, and by the way, there's a lot of suggestions it might not be, but if it's just a US problem, the government is doing all the right things to contain this and send a signal that no bank is going to fail, that they're not going to let that deconstruct the economy and all the growth and all the different good factors that are happening economically in the United States and hence globally. But the challenge, of course, is that this is an issue about vulnerability to rise in interest rates. The whole scenario that unfolded, and we can blame the management, leadership, and board of Silicon Valley Bank all we want to. The reality is that rates rose really quickly last year, at the fastest rate we've ever seen. And that created a vulnerability to those rising rates where they suddenly, what they were earning and what they were paying out were very different, and they were effectively losing money on their assets every day. So what does that mean? It means that any bank that potentially didn't recognize their exposures or didn't hedge those exposures is going to be in a situation every time rates rise even a little bit further. And so if we look at from a banking side, are they the only institutions, between SVB being the more prominent, Signature there, First Republic received a bit of a help or a cushion as well. Are they the only ones? And is it localized to the United States? And if it isn't localized to the United States, are other governments willing to step in and have the same bailout type scenarios and initiate the same actions to support their banking sectors? That, to me, that's the biggest question in terms of the first part to your answer. I'll let Jack weigh in before we dive into what's the impact on corporate treasury.
This is a classic example of where the regulatory and the monetary policy just not working. What's the head of Federal Reserve? Increased interest rates, but at the same time, he was working with Trump and others to reduce the level of regulation. So inevitably, we get this consequence, particularly when he introduced the fastest rise in interest rates for 40 years. And that's just an inevitable consequence. But the knock-on effect is being managed in the UK, for example, where the Chancellor and the HSBC got together and they covered the corporate exposure in their deposits at SVB Bank because they just had to. I haven't heard of any other protection items being introduced in other countries, but the plain fact is this started with lack of the conduct by the regulatory and the monetary policy just wasn't working. We have to get more tighter, more effective ways of conducting monetary policy and managing it. I'm not convinced this isn't the last of what we're going to see here.
There's that initial issue around cash and liquidity that was, last Friday, March 10th, where a lot of organizations thought, oh my goodness, I have X number of dollars, either at the bank or tied up in assets, or our loans are actually from SVB. There's just a lot of concern that was addressed fairly quickly. So in terms of, am I going to lose my money? That was settled in a very, very rapid way and in a positive way. So that's good. But this highlights the need for liquidity planning for corporate treasury. When I say liquidity planning, is that there's two different elements to this. One is just having complete visibility of your liquidity picture. And that's effectively what liquidity planning is. Like, the practice is taking your cash forecast and then surrounding it with data so that you can have visibility into your investments, your borrowing, not just what you actually have, but your availability, inject working capital, cash conversion cycle data so that you have a picture of how much cash do I have? Can I get to? What sort of levers can I pull to ensure that the cash and liquidity picture for the organization is where we need to be? And that can be in a positive scenario, like how do we support growth? In this case, it can be in we'll say a negative scenario where how many days of survival do I have if this happens? So it's a very scenario-based type of insight that many organizations have been doing. What most organizations haven't been doing is having this analysis on demand and in real time. And that's the trick that was really probably one of the biggest learning opportunities from this. We're recording this the Tuesday after March the 10th. So if you look back at last week in terms of when we're recording this, really you started to get a sniff of what was happening on the Wednesday. By Friday, then we had a significant problem. And in that significant problem, we had $42 billion that was taken out of the bank in a single day. And that was just the Friday, never mind what happened on the Wednesday and Thursday. That's a tremendous amount of assets. That's the bank run that caused this. This was otherwise a news item and a lot of meetings and what should we do about it, to oh my goodness, we need to act right now. That's pretty darn close to real time. Any organization that was able to access their liquidity in real time, make decisions in real time, was able to pivot and react very quickly. But anyone that was looking at this based on prior day balance and transaction reporting and maybe reconciling their cash position over a period of 4 hours to understand what do we need to do, those are the ones that were in a little bit more urgent trouble. And as a result, what we needed to do is implore organizations to utilize the tools at their disposal to be able to establish your cash and liquidity position right now in real time as of this second. And the tools exist, the APIs exist, etc. So we could have a whole webinar on the move towards real-time treasury. But the reality is it's an exercise in making sure that you have the right data, the right insights to be able to drive a more on-demand view of what your cash and liquidity looks like.
The problem with that wonderful scenario is that SVB were actually refusing to accept withdrawals through quite a bit of the previous days. Built into your treasury system needs to be an understanding that when things get tight, banks will start to not deliver the withdrawals at high speed or even real time. That's the first point. The second point is that the issue is far greater than just SVB. It's how you look at banks as a whole, you the corporate. And do you just treat them all the same? Or do you have different levels of risk or coverage depending on which bank you're talking about? That's now become a key issue, I think, in Treasury going forward. This isn't going to be the only time we hit this.
Yeah, there's a point that I just even to add on to that, because I like the way you're phrasing that, Jack, is that most organizations, whether it's in their ERP, their treasury management system, they should have some sort of counterparty risk report that has a perspective and data points around their bank exposure. And typically you would look at things like the absolute value of your relationships with each of your banks. And then you would have some third-party data around, everything from capitalization to liquidity to whatever other KPIs then would show you if something moves. And in this case, it should have been, if you looked at the right indicators, it would have been, in hindsight, a bit obvious that perhaps there was more exposure at the banking level than maybe you were comfortable with from a counterparty risk standpoint. Most treasuries, counterparty risk notifications, breaches, alarms with big red lights would probably have been triggered if they were utilizing this type of reporting with the right data supporting it. A lot of times, though, these processes are more static. And so that report might have data from last year. Well, that doesn't help when we're looking to evaluate our counterparty risk in real time or in as near real time as we possibly can. So to me, from a treasury standpoint, this is an exercise in having a unification of data and utilizing data in the right time frame so that we're making decisions based on what's happening now rather than based on stale, obsolete information.
That's well said. The key issue still remains how are you going to set the criteria assessing your liquidity risk? And what's paramount about this case and this type of situation is that the risk criteria change, and they change quite dramatically. And the issue for the Treasury team is how do they incorporate the new view of things? Or to put it another way, do they have a more complex way of understanding the market and the risks to be able to react to major events like this?
In the light of, your perspectives, you've touched upon the fact that you may be concerned that this may have some sort of a widespread ramification, perhaps globally. Do you see a contagion that can lead to a widespread banking crisis globally or regionally? And the other question I need to ask of both of you is, it's a difficult question. It's difficult to know, but do you think the Fed will go through with the rate hikes later this month?
Ooh, what a great question, Push. I still want to answer your second question first, but I'm not going to. So let's get back to the rate hike second. I think there is a risk of contagion for sure. I mean, if you look at how this particular, I guess we'll call it disaster meltdown spread, the phone was really the cause of it, in the sense that it wasn't as much the undercapitalization and the challenging profit margins and the huge losses that SVB was incurring. It was the fact that it went viral. So your ability to access mobile bank in real time and your ability to then, spin up a whole fury of hysteria via Twitter and other social media is what drove this. So that's the factor that's different from any other crisis that we've seen before. And so, yes, there is definitely a risk. I mean, we were talking just offline before we recorded this about, other banks in other parts of the world that are seeing not just their shares drop in price, but also a lot of concerns and rumors about, well, what is happening here and what is happening here. These are banks that are probably very, very solid, have no concerns whatsoever, but there's a lot more scrutiny. And that scrutiny, as we've seen for everything from, equity markets to bond markets, there seems to be like an overreaction to everything, and almost like the overreaction is the new normal. So my answer is going to be, there's going to be a lot of rumors. And if there's even the sniff of weakness or vulnerability that's not dealt with swiftly by regulators in different countries, then yes, you could see this situation repeated. I'm of the opinion that every government is laser focused on what just happened, and that'll remove any hesitation about action. They will move quickly to proactively preempt any such thing happening again in their countries on their watch.
Yeah, this, I agree with you entirely. The new framework of social media and everything else means that these crises could develop much faster, and the understanding or misunderstanding of it grows at speed. Having said that, I don't think there's going to be a global crisis. I think things are tighter. than they were. In some countries, including UK, it's been relaxed slightly, but not enough to expose us. I don't think there's going to be a global problem. And as for the interest rate hikes in the US, I haven't a clue.
I'll jump in and say, I actually don't think they will. I know they were planning to. I think we all kind of expect that. The markets even expected that. And, we're sort of grudgingly dealing with the fact that we might get a 25 or 50 basis point push. But I actually think they'll halt that just right now, because they don't want to fuel a fire that doesn't need to be fueled. They're in control. And to your point earlier, Jack, that where monetary policy and regulatory policy diverged in an unfortunate way, now I expect we'll see something a bit more in sync, at least for now. Doesn't mean that we won't do something later. And it doesn't mean that we won't push down the road the decision to finally reduce rates, which I think most people expected by the end of this calendar year. That's probably maybe into next calendar year now. But first things first, I would expect that you won't see an interest rate increase. No one's expecting it right now.
Terrific insights. Moving on to our second topic for discussion, which pertains to ChatGPT and its impact on Treasury. While ChatGPT is beneficial, there are also concerns, one of them being that they could be used for cyber attacks. Bob, you wrote an article for CTMfile titled ChatGPT for Treasury, the good, the bad, and the scary. Can you talk us through on the likely impact of ChatGPT on corporate treasury in terms of, the subtitle, which is the good, the bad, and the scary?
Just for fun, I'll start with the scary, and then we can work backwards to the good, positive stuff. You mentioned fraud. That's a great point around generative AI, which is the category of artificial intelligence tools that we're talking about with ChatGPT and ones like it. So we're already seeing evidence that cyber criminals have utilized this type of technology to increase what we call the linguistic complexity of things like phishing emails. And that just makes sense. I mean, I don't say we've all fallen for it, because I don't think we've all fallen for it, but we've certainly are 1 or 2 degrees separated from people that have from some of these phishing emails. And we look at that sort of, well, I wouldn't have fallen for that because I obviously could see the grammatical issues or spelling issues or whatever characteristics in hindsight should have been in a warning. That said, as you see some of these AI tools, specifically ChatGPT, you can compose some pretty impressive emails, pretty impressive text that eliminates some of those obvious characteristics that you would have flagged as a fraudulent email. And so there's a lot of different cybersecurity firms that are analyzing the effects of this. Several that I saw reports on were saying that they saw a decrease in schemes, but they saw an increase in the effectiveness of those schemes, which is the very data point none of us in Treasury ever want to hear. For the simple reason that they're making these schemes more real. If you combine the email, which is, let's say, harder to trace, or not harder to trace, harder to diagnose that it's an email, harder to know that it's a problem, combined with, which is the part that scares me the most, things like deep fake and the actual faking of someone's voice, which we've all seen the examples, how effective that can be. Combined, those are a lethal threat for Treasury when we're looking at the simple BEC scheme come to life in a more artificially intelligent way. So I look at that and I think, oof, that's not a good thing. Now, what does it mean? Let's go from the scary to the bad and then to the good in that order. There's an opportunity to have policies and procedures around fraud detection and prevention, around payment governance and internal compliance, like the rules that you want to follow. If you enforce those policies and you combine that with the ability to detect and act on fraudulent schemes that maybe violate those policies, or it's this type of payment you wouldn't normally send, like those sorts of violations that I'm talking about, if you're able to run those checks and validations at machine speed, not human speed, but machine speed, then you're actually counteracting that threat quite effectively. The best remedy for fraud is to ensure that you don't do a payment that you're not supposed to, regardless of who's asking. whether it's actually sounds like the CEO, et cetera, et cetera. We know all the rules. We just have to follow those rules. And it's important to be able to identify and be able to remedy those particular, let's say, somewhat out of policy or even just borderline policy types of payments so that we can reduce our exposure. There's opportunities just in the area of fraud to do better. And it's really just doing what we're supposed to do, but utilizing AI tools ourselves to consume and manage data quicker, and also ensure that our compliance and governance is intact so that we do the right things at the right times. So that's, we'll call it the fraud angle. There's a lot more fun to this. So that was the scary stuff, and I'll let Jack jump in and comment. But then there's a good part in terms of the opportunities that ChatGPT and tools like it can bring to Treasury.
I find ChatGPT scary in some ways, but also a major opportunity. My issue, though, is that if we have ChatGPT that writes the RFP, writes the TMS guidelines, writes Treasury policy, what's left for the corporate treasurer to do? The answer is a lot, but they're going to have to get used to managing new tools and spotting the fraudulent use of these new tools. It's flowing text. It's actually flowing text about something that shouldn't be happening or is wrong. And it's the ability to spot those new occurrences is what worries me. I'm not sure we're going to be able to do it easily.
I agree with you on the easily. That is the challenge. And there's an opportunity to ensure that we're, as I said, I like the word machine speed. I borrowed it. I didn't make it up. But it's a really good term because it describes the fact that we need to think and act in real time. And that's not just because maybe the fraud attempts are coming fast and furious, but it's also the fact that real-time payments are becoming more of a reality. I mean, certainly in the United States, you see FedNow coming online this year. Other jurisdictions, other parts of the world, instant payments have been more commonplace, and the adoption in every geography, in every place, in every workflow for payments around the world is starting to increase if it's not fairly fully adopted. So because those payments can operate in real time, you need your processes to operate in real time so that, to Jack's point, you don't suddenly create a problem that didn't need to be created, that you had the tools to be able to act and detect those at machine speed rather than realizing a day later, oh, we shouldn't have done that. That's the wrong scenario. We don't want that. So there is an opportunity to improve there. The flip side, though, Push, is that ChatGPT offers, in my opinion, a very different way of consuming information and interacting with things like your search engine. You know, if you look at the way we type things in Google right now, it's typically keyword oriented. You know, if I'm looking up Treasury Management System, I'm going to type in Treasury Management System. Might, add a keyword, Kyriba, for fun. But the reality is that that's the way I typically interact with a search engine. What ChatGPT and tools like it are doing, both for Google and then obviously for Microsoft, which announced that partnership with OpenAI, the founder of ChatGPT, is to make it much more question-based. So if you think from a search standpoint, you would ask instead, what is the best treasury management system? Or what are great systems or great tools for cash forecast and liquidity planning or counterparty bank exposure reporting? Like, you'd ask these in a question sort of way, and you would expect and get a much more set of detailed answers. But that's maybe just scratching the surface. That's not super fun for Treasury. It's just, ask a question like in Jeopardy as opposed to just frame it in keywords like we're used to do. It's the building this sort of question and context capability into software. So what we're seeing, I'm speaking purely from a Kyriba perspective, what we're doing is building that as a way that you would interact with the software. So we already built a skinny app just for fun. And then it turned out it actually is something that can actually be quite useful, but just for fun to see what happens if we actually built the UI and user experience of our software to work with generative AI like ChatGPT? What if that's the way that you wanted to interact with your software? You don't want to click mouse. You don't want to go to this menu and that screen. You don't want to run this report. You don't want to accumulate all of that in a pretty dashboard, which obviously people do. You want to say, tell me what my FX exposure is. Tell me what my exposure to Silicon Valley Bank is. What is the optimal time to renew my credit facility? Like, these are the sorts of questions that treasurers and CFOs have. They don't want to click on things. They want to have answers to their questions. And ChatGPT offers an opportunity to completely change the user experience for software so that software simply reacts and answers your questions. So if I'm thinking of the good, there's maybe an element of scary there too. Totally get that. But in terms of the opportunity that this presents, that's a very interesting one and quite a bit different in terms of our user experience with software platforms and data today.
I'd just like to add one point, which is that I completely agree about the impact of ChatGPT. What it brings, though, is the ability to use the technology. And that's a skill that Treasury, okay, you're helping them in Kyriba and the other TMS providers to do this, but Treasury management have to get used to a new way of working and incorporate that. The other point I'd make is that you also have to have some way of managing and controlling this. It can't all be automated. And that's the remaining question, which I'm not sure we've got an answer to yet.
I guess one thing we can all agree on is, regardless of the pros and cons, it is just going to, from a human behavior perspective, it will make sure that treasury professionals, financial professionals, everybody working in the corporate sector will be kind of forced to change and adopt a more growth-oriented mindset. Moving forward to our next story, which is about treasury work model. The battle between work from office and work from home versus hybrid work options is witnessing a clear winner, the hybrid model. It is where we are headed and is expected to be the dominant style of work in 2023 and beyond. Hybrid work has come to Treasury as well. In fact, the majority of Treasury departments are adopting hybrid work arrangements as per Strategic Treasurer's 2023 Return to Office survey. Jack, regardless of whether you would agree with the fact that hybrid work arrangement is better or working from office is better from a Treasury perspective, given what you read about the survey, do you think hybrid work arrangements is here to stay in corporate Treasury? And if so, what do you think will be the biggest challenges that Treasury will have to face to make hybrid work practice a success?
I think hybrid working is inevitable. And we've grown into this. I mean, I was working with a bank 20 years ago, and the chief executive didn't like it when you spent a day at home, but you were working and you were actually more effective. The generation change means that no longer do you see this so severely, but there's still differences. And I noticed I work with a group of some 20 treasurers, and you can see their attitudes are different depending on their age and their background. This is going to take time to filter in. The other thing that's going to take time is for us to learn more clearly what works and what doesn't in the hybrid working. It varies by company, it varies by type of management and the character of the individual treasurers. But it's going to take us time to establish more clearly what works and what doesn't.
Bob, would love your thoughts.
Sure. Well, personally, I love working from home, and I have for many decades now. The reality is, though, is that this is a culture shift, and it's a balance between what employers in a traditional sense have wanted and what we see the actual employees interested in. And it's a push-pull, right? Like, if we think of what do organizations want? Organizations want you to be in the office because they want the control, especially in areas like finance. What do employees want? They want no part of that. Do we think that this is going to land in this hybrid? I actually think it will, for the simple reason that Treasury over the past, and I'm going to say 3 years, because let's go back to the start of the pandemic, has been well trained to be able to operate and be controlled very efficiently in a remote work environment. And I know actually many organizations that would practice this well before the pandemic came along to ensure that business continuity was uninterrupted in terms of productivity, in terms of controls, and in terms of maybe extra threats that were artificially introduced just to test the resilience of their business continuity. And so they would introduce like a fraud scenario when people were on their work from home day on purpose, without necessarily telling people, just to see if the controls were as rigid in a work from home scenario as they were from a work from office scenario. I applaud all of that thinking. Ironically, it was very forward thinking because then suddenly we're all thrust into that environment. But Treasury overall has reacted very well. I know a lot of organizations and a lot of treasurers for those organizations that are very content with full-time or near full-time working at home. And they recognize that, as Jack mentioned a few moments ago, the productivity is higher. The happiness, the satisfaction of Treasury teams, which is a big problem, especially as unemployment remains low. You want to keep your people, keep them satisfied and keep them producing at a higher level. All of these things were positively linked to working from home. So I think the hybrid it's an acknowledgement that there's two different interests at play. But I also see that maybe 10 years from now, we'll laugh at this conversation. The generation that has now grown up working effectively from home and seeing that as a success will now be the ones making the decisions in terms of what the work arrangements will be. So I think for right now, absolutely, hybrid is definitely a win-win, but it may be a different leaning in several years from now, as those that like the work from home part of hybrid actually are in a position to make more determinations about what the right construct should be.
I think what this development shows is that Treasury, like ChatGPT and now working from home, there's a new set of skills and requirements emerging for the leading corporate treasurers. The team building and so on is now going to be across multiple locations, ways of working. Similarly, they're going to have to adapt to the new emphasis on AI. Changing skill set for corporate treasurers is changing dramatically.
Both of you made great insights. Both of you have worked, in different worlds, both the non-digital as well as the digital world. And both of you have seen pandemic and, lots of other challenges in your life and your experience. The survey threw a very interesting finding. I thought that one of the disadvantages or challenges, let's say, of working remote work or hybrid work is relationship management, which the survey said that when it came to Treasury, that collaborative practices and relationship management is, they need to work to improve that. So as you rightly said, 10 years down the road, it will be different. But between now and say a year from now, what do you think can be done when it comes to hybrid and remote work practices? What can be done within Treasury to spruce up the relationship management perspectives for employees that could be working in different parts of the world or different parts of the country, as opposed to if they were to come into office where, building relationships is easier?
The fact that it's hybrid right now, for the most part, like most organizations are hybrid. There's very few that I know that are completely remote. There's some. And the way that they tackle it, I think, is a lesson for us to look at in terms of being able to have meetups at certain points. And that can be maybe once a quarter or once a month. It depends on the frequency and the geographic dispersion of the teams. Certainly those that are multinational have more challenges and maybe only do that once a year. Then they'll have things that are more informal types of Zoom events. And, we could have a whole webinar on looking at that. But I think today's reality is that because most organizations are working in a hybrid environment, you have that balance of being able to work remotely some days of the week. But on, say, Tuesday, Wednesday, Thursday, You're actually interacting and you're utilizing that time to establish a base to work productively and collaboratively in the days that you're not in the office. So it almost solves itself because of hybrid. But the challenge that I think that I see anyway is to ensure that as maybe organizations adopt more of a work from home approach, and lean that direction, maybe organically over a long period of time, you don't want to lose that interaction completely. You need to find other ways to build that rapport, build that trust, and build that ability to communicate just as effectively rather than popping up your head or walking down the hall. That's the element that I think most recognized that they needed to replace, was the how do I quickly and easily communicate? And there's lots of tools to do that. But I think, we all know that if you need to have a slightly more conflicting discussion with someone, it can come across like yelling in an email, even though you spent, half an hour trying to compose a 2-sentence email just to make sure you didn't sound like you were being super mean. The reality is it probably came across like you're being super mean. These are some of the things that really need to be built in. When you trust someone very well that you're working with, you know that what their intention is. And you can disassociate that from the words that you're actually seeing on the screen. That's the challenge, in my opinion, that we need to be able to communicate more effectively, and trust and rapport are the foundation to build that on.
I would agree with that. The thing I would add, strangely, is that actually the technology has to go with working at home or a hybrid working, because in some instances, certain terminals or certain applications are not allowed from working at home. They're only allowed in the office or in the company's building somewhere. And that limitation is causing quite a problem at the moment. I think people like Kyriba and other information providers and service providers need to focus on that as well. It's not a done deal yet.
Our next story revolves around the 2023 NICE Actimize Fraud Insights report that shows that the rise of banking fraud is a growing concern for financial institutions and consumers alike. Fraudsters are becoming increasingly sophisticated, shifting their tactics from traditional account takeover and unauthorized fraud to more complex authorized payments fraud. This is complicating the fraud threat landscape and putting financial institutions and corporations at risk. As the world moves towards a cashless society, the volume of transactions is increasing. So too is the amount of payment fraud across all channels. Bob, what can corporate treasury, considered as the steward for financial risk management, do to spot emerging threats and suspicious activity patterns?
Yeah, it's a great question, because you look at a report like this and you take away one significant understanding. Fraud is more complex than it used to be. Yes, it's more frequent, and yes, the amounts are bigger, and there's a lot of different data points within this particular research, which should be completely unsurprising to any corporate treasurer or CFO, because they're seeing the same thing. And whether they are actually not seeing the same thing, they're seeing the same thing in the sense that it's happening, and you don't want to be blind to it. So what's the takeaway for Treasury? I think it's very simple, is that build a process that is resilient to fraud to the degree that you can, which means processes, it means workflows, it means controls, to ensure that the right people are doing the right things. And then build your detection, your bricks and mortar, digitally, of course, around your payment process, so that you are in that position to detect, and I used the word earlier, machine speed, all these different schemes. And there's a variety of them, and they get increasingly complex. The threat that I think the article did a nice job of touching on, and certainly I will amplify that particular data point, is that the advent and adoption of instant and real-time payments makes this a more urgent issue for corporate treasury. As we see, the adoption of real-time payments in the United States, something like 38%, give or take, of organizations utilize this to some degree already. Certainly in our consumer lives, we use instant payments pretty much all the time. And so we know which way the wind is blowing. And so the sea change towards instant real-time payments is a real one and will continue. But these payments, like, they don't go backwards. Once they're sent, they send and settle in real time. There's a non-repudiation factor, which is much more significant than any other payment vehicle we've seen before. You can't claw these things back. So as a result, the need to invest in your own systems and detection and quarantine and review process needs to also happen in real time at machine speed.
If I was a corporate treasurer, the thing would worry me most is that effectively what we're getting now is one algorithm, say in a nice algorithm in their AI system, Actimize X site, the fraudster's algorithm, and me, the corporate treasurer, is sitting there saying, well, what do I do now? And they're going to have to rely increasingly on the algorithm providers like Kyriba and make sure that they help them and give them confidence that they can compete against these fraudster algorithms. I'd ask you a question, Bob. How are you building the confidence with the corporate treasury industry that you, and give them confidence that you're on top of this? How do you show that?
There's probably a detailed answer, which we don't have time for, so I'll give the summary answer. It's about composing their controls, their governance digitally. It's a complete digital transformation of everything they were doing manually and proving to them that their policies, their procedures, their definition of a bad payment versus a good payment can all be constructed digitally and can be enforced using the same AI that often the fraudsters are utilizing themselves. And so as an example, I'll just give you a simple AI example. There's a concept, it's very simple, adversarial network. It's basically, you train your system on a good payment. Here's what all your good payments look like. In fact, we have a history of those good payments. We will show you that every time there's a payment that looks like something you've done before, it'll be virtual check mark. Yes, that's a good payment. Similarly, the adversarial part is that you also train that same network on what a bad payment is. Now, if you have had fraud in the past, well, wonderful. Then you have excellent data to be able to train the model. Most organizations haven't had very many, if any, fraud attempts that they can build into that type of process. So as a result, you'll use synthetic data. Here are the types of payments that we feel we would like to avoid. We don't want to pay someone in North Korea. We don't want to pay the same vendor 3 times in the week when typically there's only one invoice a week that we have to look at. These are the sorts of scenarios, and I can expand upon them in significance, except to say you show them that what their rule is and what their rules are, what their processes are, and what their policies are can be set up and enforced digitally. And then you show this can be done instantly. That's how what get treasurers, I don't want to say excited because this is the wrong, excited is not the word. It's more reassured that yes, good payments will continue to go through and our process will be uninterrupted. We can still operate our business at the speed that the rest of the organization expects of us in terms of delivering payments to suppliers, etc. At the same time, we have proven that we're catching these bad payments that maybe they were flagged falsely and they were a false positive, but we still appreciate the opportunity to capture those and learn from those. But we also capture the bad actors and we're able to siphon those out without interrupting the speed at which we're able to mobilize and disperse cash.
But that's really the question, is how you get this confidence in the battle of the algorithms.
Our fifth story for today that merits discussion is about Pepperl+Fuchs announcing the inauguration of a new sustainable manufacturing facility in Vietnam, financed with a US $15 million green loan from Deutsche Bank. Bob, I'm aware that you are very passionate about ESG, the world of sustainability and ESG financing. And in the light of this development, do you expect more corporates to pursue the ESG financing journey and perhaps set up new sustainable manufacturing facilities worldwide?
Yes, and I welcome every bit of it. So anything that's more focused on green, lighter carbon footprint, increased sustainability, From a personal standpoint, these are all very positive things, and I'm so happy to see them. But this isn't just a personal standpoint. This is in terms of what the markets and what overall business is trending towards. And incorporating ESG into things such as ratings, such as the ability to receive and qualify for better credit or better loans or more liquidity. Ironically, as pleased as I was to see that particular news item, and it's great. I'm glad to see in emerging nations be able to be part of sustainable manufacturing. I think that's really important, and I'm glad to see Deutsche Bank being part of that and recognizing the opportunity that that means. In the same article, there was also an index by Finastra that was talked about, and I saw that as well, because that's the sort of thing that will encourage more of this to happen. And we see that in terms of overall lending. We see that in terms of things like supply chain finance, where you're going to see preferential terms being offered to those with higher and better ESG ratings. And we're just at the start of that cycle, of course, but I am very pleased to see that level of data and quantification of what is good versus maybe not as good practice around ESG being incorporated into financial practices. That's a positive for me.
Yeah, it's a positive for me as well. The issue, though, is that we're getting inconsistent behavior. Deutsche Bank have done some greenwashing for investment in Germany, hundreds of millions of dollars. Yet here they're in Vietnam, they're doing a tightly linked ESG investment, which is very good. But I would like to see more consistency between the players. At the moment, we're not. We're seeing it varying by country and by industry, which is not good.
Finally, gentlemen, what is your choice for the biggest or most important story of the past week and why? Jack, if I may ask you to answer this first.
For me, this podcast has been an example of how the skills of the corporate treasurer need to get wider and more complex. They need to be able to understand the battle of the algorithms while at the same time managing new working skills. It's an increased requirement for the corporate treasurer to have multiple skills.
Well, the big story, I think, is obvious. We're recording this in the middle of March. So for those that may be listening later, they'll think, oh, SVB, that was a long time ago. But as we're recording this, the big story is Silicon Valley Bank and the implications of that. The implications are wide ranging. I think everything we talked about today is one degree of separation from the opportunity for Treasury to learn a lesson and to implement change. And it comes down to recognizing that there's a need to be able to consume and act on data in real time, so that if there's a bank failure, if there's a fraud attempt, now I'm touching on different stories for fun. If there's an opportunity to be able to deploy cash or liquidity or deal with market volatility, you need to consume data and you need to build a process and insight and probably dashboards and all sorts of workflow in real time to be able to avoid the bad and embrace the good opportunities that can come.
Thank you, Bob and Jack, for your informative analysis and discerning insights, particularly about the collapse of Signature Bank and Silicon Valley Bank, as well as ChatGPT and the hybrid work arrangement discussion. We would like to thank our CTMfile audience for joining us in this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.